Did you know that depreciation, while it is a cost, provides protection from taxes? Let's talk about that. Let's talk about depreciation, tax shield, and salvage value. Talking about net present value, we need to look at cash flows and, of course, the required rate of return. These cash flows, in turn, are influenced by depreciation, which is not a real out-of-pocket cost. It's not a real out-of-pocket cash flow. But nevertheless, it does influence our cash flow because higher depreciation now reduces our tax payment, as depreciation is some additional abstract cost, hence reducing our tax payment. And in doing so, in reducing the tax payment, we might think of a concept such as depreciation tax shield. Again, as depreciation in this case would protect the company from relatively higher taxes. Let's see how exactly it works. Let's have a look at these two very simple income statements. One without depreciation and one with depreciation. In the first case, without depreciation, sales revenue 10,000 minus the cost of goods sold 4,000 gives us EBIT and EBT, as there are no interest expense, of 6,000. 30% of that is going to be paid as tax payment, which is 1,800. And net income is going to be EBT minus that tax payment of 4,200. In the case of the income statement with depreciation, the earnings before interest and tax and earnings before tax, as there is no interest expense, is going to be equal to the sales revenue minus the costs minus depreciation, which is 5,000. The tax payment out of that is going to be 30% of EBT, which is $1,500, and net income is smaller. However, the depreciation is only an abstract cost. It's not a real out-of-pocket cost. So talking about the depreciation tax shield, what we want to look at is the comparison of the tax payment in these two scenarios. In the income statement with depreciation, we see that the tax payment is exactly $300 less than in the case without depreciation. Hence, the tax shield can actually be calculated using this formula. Depreciation tax shield is equal to the amount of depreciation multiplied by the tax rate. As to net income, even though net income is lower in the case with depreciation, as depreciation is an abstract cost, we should probably look at the actual amount of cash that the company generates rather than looking at net income. So operating cash flow is, of course, earnings before interest and tax plus depreciation, which is zero in this case, minus tax. Without abstract depreciation costs, operating cash flow is same as net income. In the second income statement, operating cash flow, again, earnings before interest and tax plus depreciation minus tax, is actually 4,500, which is exactly 300 greater than the cash generated on the left-hand side without depreciation. Again, that same value of $300 shown by this formula. Moving on to salvage value. There are actually a couple of definitions for salvage value. I like the definition where we look at salvage value as the remaining value of an asset, such as a used car, after its useful life. Useful life in accounting is the expected number of years that an asset is supposed to remain operational within a business. There is another definition of salvage value which says it's equal to the book value after depreciation, but I prefer to stick to the first definition. Hence, with the salvage value being different from book value, it can sometimes be greater than book value. In which case, when the company sells an asset at the market price greater than book value, the company would have to pay tax, not on the whole sales value, but on the difference between the salvage value and book value. And vice versa, if the salvage value is lower than book value. If the book value of this car on the balance sheet of a company is $10,000, whereas the company only manages to sell this car for $8,000, this difference of $2,000 can be used as an additional cost for tax deduction. So with this tax payment or tax deduction involved, we want to have a look at salvage value after tax. So after tax, that of course would be equal to the sales price of the asset of this car, let's say, minus how much tax we would have to pay on the difference between this sales price and the book value. So we would have the sales price minus the difference between the sales price and the book value multiplied by the tax rate. And this formula also works in case of tax deductions, because in that case the sales price is smaller than book value. This number in the brackets is negative, multiplied by the tax rate, with another negative sign outside the brackets, gives us a positive value which is added, so to speak, to the sales price as a tax deduction to the profits of the company. Let's have a look at a quick example. Let's say a company buys a vehicle for $24,000, which is supposed to last for 8 years. In the first column we have years here, for now going only up to year 3, and annual depreciation every year, assuming straight line depreciation, is going to be equal to this starting value, the original cost of this vehicle, divided by 8 years. That's only in case of a straight line depreciation, giving us $3,000 per year. The book value at the end of year 1 will be the difference between the starting book value and depreciation during that year, giving us $21,000. At the start of year 2, the book value is the same as at the end of year 1. Straight line depreciation means that depreciation is the same every year at $3,000. And we have our table of book values within the first 3 years. Say at the end of 3 years, the company sells this vehicle for $20,000. While the buyer gives $20,000 to the company, how much is the after-tax salvage value? Again, according to the formula, that would be equal to $20,000 minus the difference between these $20,000 and the book value at the time of the sale, which is the end of year 3, multiplied by the tax rate. Again, let's say the tax rate is 30%. So after paying the taxes on this difference, which is going to be 30% of the $5,000, the after-tax salvage value is going to be $18,500. And again, the same formula works in case if the car is sold for under the book value, for $10,000, let's say. In that case, the tax deduction applicable to the other profits of the company is 30% of this difference of $5,000 again. So in addition to the $10,000 from the buyer, the company will get another $1,500 of tax deductions with a total after-tax salvage value of $11,500.